Does the present crisis, which looks like deflation, emerge into super or even hyperinflation? Each year from this point until 2015 will rack up between $1.5 and $3 trillion of new debt on top of what already exists. The Fed is running out of options. They've dropped interest rates to virtually nothing, and that's been very ineffective. They've talked about monetary easing, which is another way of saying we're going to inflate the currency. It's not a question of if, but when.
The Swiss are even planning to monetize Swiss corporate bonds.
When you hear language like monetization, to most people that is just a sterile 10-cent word that has no real connection. What it means is nobody's buying enough of our debt. We can't finance our debt. Just like someone may not lend you money, someone's not lending the US government enough money to pay our bills or to make payments on our national debt. What do? We'll just buy it ourselves then. We'll just buy it ourselves. And that's essentially what monetization is. The effect in terms of real world consequence is instant inflation. And that's what we're in the midst of already. So that the context of inflate or die, the 2002 speech from Bernanke, which implied that he could drop money from helicopters, we're already there. And the question is, can a hyperinflation come out of a depression or come out of a deflationary scenario? The history of deflationary depressions, 95% of the time they resolve themselves in hyperinflation.
You need to go back and study the history of Weimar Germany, where they went from a little bit of inflation in 1919 and it escalated all the way up until, finally a gold coin that would sell for a few hundred German marks in 1919 was selling finally for trillions of dollars, and that simply reflected the fact that their currency went to absolutely zero. We see the same thing happening in Zimbabwe today.
It simply is not, I repeat, is not a liquidity crisis. We're broke, we're dead broke already.
The deficits are off the charts. Now, once again, remember earlier we said that you can't trust the government numbers. And so when they've told us the deficit is 200 billion or 300 billion or 400 billion, the question is, how high is really the deficit? Well, when you look each year at how large the jump in the national debt is, that pretty much tells you what the deficit is. Well, the national debt in the last 12 months just jumped $1.5 trillion. Now that's the real deficit.
How's the government going to finance the $2 to $2.5 trillion? They either are counting on the kindness of strangers, financing from the Japanese and Chinese and Middle East banks, or they monetize.
The Fed is printing money like there's no tomorrow. They're taking interest rates down. They're going to take interest rates almost to zero, just like they did during the Great Depression. And remember, 0.5% interest rates through most of the Great Depression did not stop the Great Depression. Zero interest rates in Japan did not stop their 15-year depression. So they're doing that, but they're running out of gas on that. And so if that's not going to help, what can we do? We've only got one arrow left in our quiver, and that is to run the printing presses. And they are creating money now by the trillions of dollars a year, and the implications for that ultimately collapsing the US dollar and causing inflation, superinflation, ultimately hyperinflation.
Warren Buffett and a growing number of Wall Street gurus are beginning to anticipate the inflation which is ahead, looking at 1980 numbers, 15% inflation, as a reasonable estimate of where we go very soon. Tax revenues, they'll be down 15% or more in 2009. If we raise taxes on the productive class, as Obama has promised, President Obama has promised, sometime during his administration, it will crater the economy and the markets. And I think that's some of the strain and tension that we're feeling in the stock market now. It'll have to borrow, the government will have to borrow the money from foreigners or from US citizens via bonds if there's willingness to fund those deficits. This, we think, will crowd out private borrowing and put severe upward pressure on interest rates. So the context for the next 2 to 3 to 5 years is increased inflation, deficits going off the charts, and interest rates starting to scale up. If you can't borrow the funds, of course, they will monetize, and that's already been announced. I think it's amazing that people still have not done anything. They haven't taken action. They're stupefied and paralyzed by the fact that they're experiencing financial loss, and what they're pushing back to is hope, and it's not a reasonable, well-founded hope. It's hope that is based on fiction. We're in a different environment. We're in a very different landscape financially and economically. The GAO, Government Accountability Office, has run simulations, and they do think we can balance the budget by 2040. There's two scenarios in which that could happen. The first scenario would include cutting total federal spending by 60% and raising federal taxes to 2 times today's current levels. That's one solution. The other solution to close the current long-term fiscal gap is if you had uninterrupted growth, double-digit growth in GDP for the next 75 years. Now, double-digit growth for the next 75 years uninterrupted, you have to realize that the boom time growth averaged 3.2% per year.
From 1919 to 1923, the German government began to run the printing presses in order to pay for their war reparations. And they ran them faster and faster and faster. And so they went from a depression, a deflationary depression, to an inflationary depression, and finally to hyperinflation. In 1919, you could buy a 1-ounce gold coin for a few hundred German marks. By 1923, that same 1-ounce gold coin you could buy for in the trillions of German marks. Gold didn't really go up in that period. The currency went to zero. You see the same thing happening in Zimbabwe today.
Inflate or die. Reserve balances held with the Federal Reserve are now $592 billion, up from $15 billion in August of 2008. The Fed has violated 2 principal tenets of central banking. First, don't lend to insolvent institutions. And second, don't lend on anything but the most pristine collateral and at a penalty rate. That's the former president of the Cleveland Fed. In the short run, what we have seen is severe price deflation, not monetary deflation, but price deflation. A collapse in energy prices, a collapse in commodities, a collapse in auto sales, a collapse in retail sales. However, on a long-range basis, our present exploding money supply will ignite, in our opinion, a new round of monetary inflation, very possibly beyond anything any of us have ever experienced. The supply of US dollars is now burgeoning at the fastest rate in US history. Having a strategy, having a plan, it requires that you understand the context that you're in today and be able to anticipate what that context might look like, what it might be tomorrow.